Hello there, Dorian Daily listeners, and welcome to the fourth episode of the Dorian Daily podcast. Today's quote comes from the late great Albert Einstein, and it reads, "Compound interest is the most powerful force in the universe." Chose this quote because it's consistent with our topic today, which is Investing Basics 101, compound interest being one of the main factors in investing and one which will generate you hopefully a lot of money throughout the course of your life. I'm hoping to shed a little bit of light on how to do that today, specifically by comparing and contrasting the differences between savings accounts, be they high interest or tax-free, mutual funds, and exchange-traded funds. Before we delve into it, I wanted to share two phenomenal sources which have helped me in personal finance and understand some of the issues facing Canadians in the banking sector. One is Beat the Bank by Larry Bates, which outlines the true cost of banking with the big five banks in Canada, those being TD, BMO, RBC, Scotia, and CIBC. And the other source is a podcast called Build Wealth Canada. It's created by Cornell Schreiber. And it's a phenomenal podcast which parallels a lot of the things that I'm going to be discussing in this episode today. So if you want to dive into more material, I definitely check out the book by Larry Bates as well as the podcast Build Wealth Canada by Cornell Schreiber. So to start things off, I guess we could talk about savings accounts. I'm sure many of you know, many probably have savings accounts at one of the big five banks. And this is generally the worst place to keep your money insofar as the rate of return that you're obtaining by keeping your money in a savings account is generally nominal, if anything. So it would be 0.5, maybe if you're lucky, 1% per year. However, the rate of inflation in Canada is generally between 1% to 2% per year. So you're actually losing whatever your nominal savings rate is, subtract the rate of inflation in Canada. So hypothetically, last year the rate of inflation was 2% and you earned 0.5% in your savings account on your money. You actually lost 1.5% of the purchasing value or the purchasing power in your investment account or your savings account. So that is not a good place to keep money. However, it is extremely liquid, so while it may be prudent to keep like a slight emergency fund for unforeseen expenses, so you can just access the cash right away, but as far as actually building your wealth and your personal capital, I would not advise keeping it in a basic savings account at one of the big five banks. The next option is a mutual fund, and this is by far what the vast majority of Canadians invest their money in, be they, doctors, lawyers, teachers, even people who work at the banks themselves. They put their money into their bank's mutual funds. And it really pains me insofar as Canadians don't know what exactly it is that they're paying to get into these mutual funds. They just go into their local branch. The people are super nice to them there. And they say, I got some money to invest. What should I do with it? And the quote-unquote financial service representatives, who are really just salespeople, say, oh, you can put it in our mutual fund and watch it grow before your very eyes. Average Canadian says, sure, that sounds great. And they walk out of the branch without really knowing what type of financial product they bought and what they're going to be paying for that type of financial product. Generally speaking, the rates of return on these mutual funds are mediocre at best. Most yield somewhere between 5 and 7% after the management expense ratio. The management expense ratio is calculated based on the annual fees plus the annual expenses divided by the net assets in the mutual fund. Generally speaking, the big five banks, the mutual funds they offer, the management expense ratio is between 150 to 200 basis points. So that's, for non-finance people, that's like 1.5% to 2% per year. Not just 2% on the amount you've gained in profit, but the entire amount of money that you deposited into that mutual fund. So to really drive this point home, I want to tell you a story about Jimmy. Jimmy has worked really hard. He's 35 years old and he saved up $100,000. He's listened to this podcast and he knows that he doesn't want to keep it in his savings account. So he says, okay, I want to invest this $100,000 for my retirement. I'm 35 and I want to retire at 60. And I've calculated that, if I just put just this $100,000 and be super frugal and everything else, I should be able to reach my goal. So sales rep at the bank or the financial service representative says, sure, no problem, Jimmy. We got a great mutual fund for you. You can put your $100,000 in and you can earn an average of 7% per year for the next 25 years. And by the time you're ready to retire, you'll have $542,743 in the bank. Jimmy says, that's great. And he walks out without thinking twice. However, Jimmy failed to ask the most important question after the expected annual return, which is, what's the annual fee that I'm paying you to get me that return? And presumably, if the management expense ratio on the fund that Jimmy just bought into is typical of a Canadian big bank mutual fund, he'll be paying, say, 200 basis points or 2% over the next 25 years. That means it's a total management cost of $126,498.08. And that's just in the money that he's paid them, because in economics, he has the opportunity cost of using that money to invest it elsewhere. If he invested it elsewhere and received a similar rate of return of 7%, he actually lost earnings of $319,564.81. To put it differently, from the initial $100,000 that you gave the bank, you made $442,743, and they made upwards of $319,564 by reinvesting the management expenses that you provided for them. It's really something else, and it continues to blow my mind that the banks get away with this type of highway robbery and extremely expensive fees. Mind you, if they were able to return above market mean, the market mean is just over 8%, and it's understood to be benchmarked against the S&P 500 index. So the Standard & Poor's rating agency, they track the 500 largest companies listed on the American exchanges, and that generally is what portfolio managers and investment bankers benchmark themselves against, is did they return above or below the market mean, which has been 8% since Standard & Poor's started tracking the top 500 companies publicly listed in the American stock exchanges. But the reality, so if they returned above market mean, a la, Warren Buffett consistently did, a la Julian Robertson of Tiger Hedged Fund, or Michael Steinhardt, some famous hedge fund managers that consistently returned above 20%, I would be happy to give them a 2% management expense ratio, which is what their top hedge fund managers now are requiring. But the reality is that they're basically giving you market mean and then charging you 2% to meet the market. So it's not worth it to you. You can get the market mean for a much better price, and I'll tell you how. So as much as I love trying to beat the army of bank analysts at their own game and applying value investing principles to try and find good stocks to buy into, like individual company stocks, I think the average person in Canada doesn't want to spend their whole day trying to find stocks and beat the full-time analysts and investment bankers at their own game. I think trying to take that space in the equity market and buy individual company common shares, it's a little bit crowded. Everyone and their mom and their dad has an opinion about what's the hot stock, but the reality is, for most Canadians, they don't need to be bothered from their day-to-day lives, doing things they enjoy, seeing their family, by sitting in front of a desk and looking at BNN and scrolling through financial reports to see what a good deal is. Although maybe in the future I will do an episode on my approach to value investing, or picking companies that are good to buy into in terms of a individual company common share perspective. I also know an investment strategy, which maybe again could do another episode on, which is essentially people try and just invest in companies that pay out the biggest dividends. So by buying common shares, you're a part owner of the company and you're entitled to you're not entitled, but management generally pays out the owners a share of the profits. So, some companies you can get a really strong dividend yield. So 4% of the share price or for some big blue chip companies, and that's like income annually, like in your pocket. And so a lot of, especially retirees who are active in the equity markets, they base their investments on dividend yield, even if it's a really expensive stock price, just because the company, like in terms of like a price to earnings ratio, people pay high dividends. But that's sort of down another rabbit hole, which we can discuss in another podcast. For now, I'm just going to say that we've done savings account, probably is definitely no good. The mutual fund, I've told you to be highly skeptical and look at past performance records and look at the management expense ratio and see whether or not you're beating the market as measured by the S&P 500. And if you're not, then you can quite simply just do what's called indexed investing or exchange traded fund investing for a much cheaper cost. Given the advancements in technology, even the big Canadian banks, they've opened up investment platforms for retail investors like ourselves to cheaply purchase securities and to hold them in a portfolio that we direct, be it in a non-registered or a registered account. And I've personally been a huge fan of exchange traded funds. So the two major exchange traded fund providers are BlackRock through their iShares and Vanguard. The founders of these companies really revolutionized the retail investor game and made it such that every person could get a quality group of stocks, which an exchange traded fund is really just a collection of securities, mostly stocks, but it can be other types of securities too, such as like bonds and T-bills and other things that are marketable on a secured securities exchange. But they do it in a much cheaper manner, and so far as the management expense ratio is generally only between 15 to 30 basis points. So as opposed to paying 150 to 200, so if 1.5 to 2%, you're paying 0.15% to 0.3%, or at most maybe 0.4 or 0.5%, and that adds up huge over the span of your investment lifespan in terms of the compounding effect of the fees that you're paying. It's depending on the size of your portfolio, it could save you tens of thousands to hundreds of thousands of dollars. And I know people are tentative to buy exchange traded funds. They I know nothing about the stock market or investing, I can't do it. But the reality of the situation is you just need to think about what your risk appetite is. So generally speaking, the more risk adverse you are, the less likely you'd be in common shares and equities. You'd probably want to be in T-bills or like government bonds, especially like developed countries, because the risk-free rate of return is considered to be the treasury bill rate. And it's like U.S. Treasury or Canadian, like the Bank of Canada, like their T-bill rate. Investing in those types of securities are considered to be risk-free because the government's not going to default on the debt. They could just raise taxes, or given the current monetary system in the 21st century, just print more money and pay it off. So, and then the more equities or common shares that you take on in your portfolios, the more risk you're taking on, because some corporations are very big. They're not governments, so they can't actually take money out of people's pockets with the coercion of the state. They have to rely on providing a good or a service in order to get that money. So once you've established your equity ratio, so what percentage you want to be invested in stocks and what percentage you want to be invested in like government bonds or treasury bills, then you've discerned your risk appetite, and then you just need to decide, okay, so what markets do I want to be exposed to? Generally speaking, there's a home country bias. So if if you live in Canada, you're more likely to be invested into the Canadian market, just insofar as you know the companies that are there. Or if you live in the United States, you might be invested to a little bit more on the New York exchanges, the New York Stock Exchange or the NASDAQ, just by virtue of the fact that you know the companies. In Canada, the big companies are vastly financial services, so like the big five banks and insurance companies and utilities, so like Enbridge and Hydro One, all those types of companies, as well as mining companies, huge natural resource capital on the Toronto Stock Exchange. And then like the Bell and the Rogers, the big blue chip companies, Loblaws. And the New York exchanges are generally have a little bit more diversified insofar as they have pharmaceuticals and tech companies in the United States that are listed on those exchanges, which Canada doesn't really have a lot of pharmaceutical and tech companies that are listed on the Toronto Stock Exchange. So to take an example, I'm very I have a high risk appetite, young person, I can recover some losses. I got time before I retire. I can get paid to take on more risk, but well above the risk-free rate of return. I go the market mean of 8%, or I could try and get even higher with more volatile securities. So I've decided that I want to invest 90% in equities and 10% in bonds. So I'll buy just 10% of the Bank of Canada, Treasury bills and their federal government bonds, and I'm going to get that money no matter what. Like that's 10% of the portfolio. The remaining 90%, I want to be 40% invested in the Canadian market, 30% invested in the United States, and then another 30% invested in, say, emerging markets. So do I have to go look up all these companies and decide which ones I want? And no, you don't have to do that. That's the beauty of exchange traded funds. So for the 30% of my American portion, I just want the biggest companies in the United States that are publicly listed. So I can go to my brokerage, TD, CIBC, they all offer this. I personally use Questrade to buy the securities because they're the cheapest. You can buy exchange traded funds for free, and then you just pay a small commission when you decide to sell. And it's very great platform, easy to use. I have no complaints thus far. So log on, go to trade, and deposit whatever much I want to invest. If you're investing on the American exchanges, you need to have it in US dollars. And there's a way to make it so that you can get your exchange essentially at the spot rate and just pay a commission. I'll do an episode on the Norbert's Gambit one day. And then if you're investing in the Canadian exchange, you need to have it in Canadian dollars. And so for my American 30% of my equity portfolio, I just want keep it simple, couch potato investor. I don't want to have to look at it often. I can just pick one of the exchange traded funds that tracks the S&P 500. So Vanguard, it's the VOO ticker, and the management expense ratio is 0.03%. So it's markedly lower than what you're paying the big banks to basically get this exact same return minus 2%. So going back to our friend Johnny, if you remember him, the 35-year-old gentleman, hard worker with $100,000 who gave his money for 25 years to the big five bank mutual fund that yielded a 7% return with an expense ratio of 2%, and it cost him lost earnings of $319,564. With this exchange traded fund, he is getting a higher return insofar as the S&P 500, since this particular fund, since its inception, has been quite good. It's been at 11.8%. But even if I calculate this conservatively and put the mean S&P 500 market return since its inception and is at 8%, Johnny is losing earnings on this exchange traded fund of $4,771. So that is a difference in lost earnings because of the management expense ratio of $315,000. Johnny has effectively made an extra saved $315,000 by choosing the exchange traded fund option instead of the instead of the mutual fund option, and he could probably retire a lot earlier with that $315,000. Now, it's important to understand the concept of diversification, the ability for investors to decrease their systematic or unsystematic risk, so their company-specific risk, by virtue of holding different securities in different countries. So you don't want to be invested entirely in the S&P 500. Indeed, as I just said, I'd personally only do about 30-40% of my portfolio in the S&P 500, and then the rest you could put in, say, if you want to get a Canadian exposure to the Toronto Stock Exchange, like the TSX 60, they have exchange traded funds at similar management expense ratios, whereby you own the top 60 companies in Canada. So I guess I should have said, with respect to the Vanguard or the S&P 500, so you're indirectly owning companies like Microsoft, Apple, Amazon, Alphabet, Facebook, Berkshire Hathaway, JP Morgan, Johnson & Johnson, and Visa. If we take the iShares Toronto Stock Exchange TSX 60 index ETF, so the top 60 Canadian companies, the securities listed on the Toronto Stock Exchange as ticker symbol XIU, and it's returned since inception 7.02%, so similar to our bank mutual funds. However, the management fee is only 15 basis points, so 0.15%, as opposed to 150 to 200 basis points, 1.5 to 2%. And the companies that you're holding and getting dividends from indirectly are the big five banks, coincidentally. Surprise, surprise, that they're the biggest companies in Canada, as hopefully we've showed you a big reason why. It's not that they're genius investment banking side, it's that they're making money off retail investors. So you're owning Royal Bank of Canada, Toronto Dominion, Enbridge, Bank of Nova Scotia, Bank of Montreal, Brookfield Asset Management. They're just big blue chip Canadian companies. And if you wanted to round out your portfolio and develop like European exchange traded fund, like on the London Stock Exchange, or emerging markets like a China one, which again, this brings up an important point, is that this is not like guaranteed return every year, and you have to have a risk appetite to be invested in equities, because on any given year, if you look at like the 2008 financial crisis, you would have lost like 30% of your entire portfolio in a single year. However, as we're at the tail end of one of the largest longest bull market in world history right now, and you would have made back if you held on to your securities, which, as Warren Buffett would say, the ideal holding time is forever. If you were to held on to your securities during that time of like turmoil in 2008, you would have made your money back by now, and then some. So it's interesting time. I think that being at the end of the bull market, and for those who don't know, it's called a bull market because when a bull attacks you, it goes up with its horns, and then a bear market is when prices are going down because a bear claws you down to the ground. So here's a kind of funny joke with finance people: is it better to invest in a bull market or a bear market? And the answer is depends if you would rather get gorged or mauled. So I thought that was pretty funny. But the reality of the situation is that there's no ideal time to enter the market. If you sit on the sidelines right now because you think there's going to be a correction or a recessionary period in the future because we've had such a long bull market, you're missing out on potential gains right now. And like we said, if you're just holding your money in a savings account, you're missing your purchasing power is being devalued right now. And then again, if you refuse to invest money in a bear market, so like in a recessionary period, then you're potentially missing out on better deals in terms of like companies that may be taking a hit and are trading at prices below they would normally be at because it is a recessionary period. However, for our purposes, going back to the exchange traded fund, to round up the exchange traded fund discussion, we need to be cognizant of the fact that it might be prudent to speak with a fee-for-service financial planner to say, okay, this is my risk appetite and this is what markets I want to be, and they'll be able to tell you which markets with that appetite you should be exposed to and which balance you should have your portfolio at in terms of equity, taking on some risk, to like government bonds and safe investments. The more conservative you are, the more you're going to want the latter, not be in the equity market, because you can't stomach losing 30% of your portfolio in a recession. But when you're buying, the exchange traded funds through these platforms, it's probably best to ignore the day-to-day market headlines. You can get too caught up in it, and just keep reminding yourself that, if you look at the Toronto Stock Exchange Index, or you look at the S&P 500 Index, over the span of decades, it has been continuing to go up and generate huge amounts of wealth for individuals. And I think that the listeners of this podcast, have like the ability to do it themselves, perhaps with like the advice of a fee-for-service financial planner, not a salesperson at one of the banks, to set their goals, set their targets, and then it's from there they can buy the exchange traded funds and just essentially be a couch potato investor. Let Vanguard and BlackRock do all the buy and sell for you and maintain those portfolios at a very cheap price. And then for your side of things, maybe 15 minutes twice a year, just to check it every 6 months and make sure that you're balanced, so your equity to your bond position is where it's at, that your portfolio is still 80% equities, your equities have gone up and now they encompass 90%, they've done well and they've encompassed 90% of your portfolio. You might want to sell some and buy some government bonds so they can go back to your 80-20 range, or whatever your range may be. But that's super easy on these platforms. It takes about 15 minutes, and you don't have to fret too much about the investment or the general market trends, the ups and downs, or like having to sell a stock when it's hot, or getting shorted when it's not. So I think that it's definitely worth looking into. And again, I would highly recommend looking up Beat the Bank by Larry Bates for a little bit more detailed discussion of the matter of exchange traded fund investing. Although I think he's actually a supporter of, I know he's a supporter because I read the book, of just buying blue chip stocks. So like big companies, be they like Walmart, Procter & Gamble, Coca-Cola, McDonald's, like Amazon, just buying those companies and taking the dividend every year and just keeping the stocks and not worrying about the prices. But the beauty of the exchange traded fund is that if you have the top 500 companies in the US and you have the top 60 companies in Canada, then you have these companies, and that if one of them drops out of the top 500 or drops out of the top 60, they're getting replaced on the fund. So you can have confidence that you own the best companies in North America indirectly through the exchange traded fund, and you don't have to worry about beating the market, so to speak, or how your portfolio manager is doing, because all they're trying to do is beat the market. And the reality of the situation is, contrary to what some cocky investment bankers may tell you, is that it's extremely difficult, if not impossible, to consistently beat the market. You have to be a genuine superstar, and those are few and far between. And for retail investors, you're not going to beat analysts. Actually, it was a funny article. I forget the author, but if you Google it, they did a research study, and they found that a group of monkeys throwing darts onto a list of the S&P 500 companies, they were found to beat like a large portion of Wall Street investment bankers in terms of generating better returns and quote unquote like beating the market. So and that's not a joke at all. It's dead serious. So you can look it up in it's academic literature. It's really funny that was their conclusion, or those were their findings in that study. But it's true. It's a crazy messed up world with all the bulls and the bears and the monkeys throwing darts at stock charts, but it's the one in which we live, and one which we can hopefully live through a little bit more richly if we educate ourselves and are a little skeptical about the financial products that people are trying to sell us. Thanks so much, everyone. Hope you have a great weekend.